Today we're going to be talking about thinking at the edge of the box. Stay tuned, traders. We'll be right back.
Okay, traders, just a reminder, the link for the PEPPERSTONE webinar, many have emailed me still. I've been putting the link in the description box. It's right below here. The link is attached. You can just click on the link. It'll bring up a page for you to just reserve your spot. And again, that's Thursday, October 15th, 4:30 p.m. Australian Western Standard Time. And so wherever you're at, Google that. If you hit this link, it'll show it in your time. But again, that link for this Thursday's webinar, and I believe Premium Client Advisor Zoran Kresovich will be on with us as well to answer any questions that traders have. Zoran's been a fantastic relationship for me at PEPPERSTONE. And
Good day, traders. I'm Stacey Burke from Stacey Burke Trading. Tuesday, we had some very good moves on a couple of the pairs yesterday, gold also. Today, in my endeavor to keep things as simple as possible and keep breaking things down simpler and simpler, we're going to be talking about learning to trade at the edge of the box. Not outside of the box, not inside of the box, but at the edge of the box. Before we get to that, just another reminder, this Thursday, October 15th, the PEPPERSTONE webinar, Professionally Speaking, with myself and Chris Weston. Chris has worked for Merrill Lynch, Morgan Stanley, Credit Suisse, and is now the head of research at PEPPERSTONE. And we've had a run sheet. I'm going to just highlight a couple of things that Chris is going to be going over. He's going to be going over the Brexit end of the talks, the trade agreements, the fundamentals, where he sees the risks to the GBP and how that may affect volatility in terms of how that will be tradable, whether it may be too volatile to be traded or the volatility may be, depending on the results of the Brexit deal, how that potentially can affect us as traders. We'll also be discussing the U.S. elections, the polls, the forecast matrix, how that will impact on the currency markets, the equities, gold, possibly even oil. We'll be discussing that as well. We'll be going over some charts on the short-term strategies that I use and that I talk about here. Also the Federal Reserve and how certain changes to what they've discussed may actually impact the markets, because they can change that on a whim, even though they've made promises. But Chris is a brilliant researcher. He puts together his own data and compiles them and overlays them with each other. He's just an amazing guy, and I'm sure I'm going to learn a lot Thursday and hope to provide a lot of value for everybody as well. We'll be discussing position sizing, risk management around the events, and how that can potentially help us to avoid any major damage to our trading account. So again, that's Thursday. The link is below. And again, just before we get started, thanks for all the comments, the questions, the feedback. Thanks for the like buttons, the notifications. Again, my primary focus here is to provide value every single day. It helps me stay on track. I provide what I think is probably the truest to form for retail traders who are trying to make it in this market, because it is a winnable game. I didn't have that. It took me a lot of time to piece things together, and the market never stops teaching us. And I think the number one thing is that you have to have that openness to realizing that this is a zero-sum game. It is us against them. They are there to take our money. And now I know from the feedback that I'm getting and the emails, the amount of emails I'm receiving right now is unbelievable from traders who are finally seeing that this is not about technical analysis and fundamentals and all these other things, that it is actually a market that is designed to steal our money. But knowing that, and knowing that there is an organized design to this market, there's nothing stopping us from piggybacking on the smart money and profiting from those moves. So coming back to the things that I've learned, a lot of them the hard way, piecing together bits and pieces from a lot of people, a lot of hard painful learning, and peeling back the onion to the simplest steps possible and sharing that along the way. And the object that I constantly emphasize here are these are trades that I focus on that I can scale up in size. I want to be at the high of the day or the low of the day. Yesterday was a textbook perfect day. We're going to go through those 4 pairs as well as gold to talk about 2 of the trades I did take, and also how to filter out trades. But the simplest thing we're going to work on today is just understanding that every single day, every single week, every single month, we're in a box. They put a high of the box in place if we don't already have one, and they put a low of the box in place if they don't already have one. If we already have one, they either break through it and work into it, or break through it, or they work into one side before jamming traders in, locking it in, and then moving back to the other side. And the telltale sign of when they've done their job is we'll get the engulfment and the pin hammer. And the most important thing to all of this, whether you're on the session timings, the Monday to Friday 3-day cycle, or the monthly 3 weeks, 3 months, the same things apply. Once they lock it in, and the longer time frames, it's just as relevant when we have options expiries, futures contract rollovers, end of the month for locking in the books and renewing their next month and the next week and the next day, the 24-hour cycle. It's all the same. When they're done doing business there, they're going back to the other side and they're going to go after the money. It's all about the money. If you don't understand that, we're going to look at a couple of the Goldman Sachs filings on how much money is actually made, and you can go and Google these yourself and go back and look day in and day out how much money is being made by the smart money. So we've talked about yesterday's high, yesterday's low. Okay, let's just assume that we're inside. It doesn't matter. Go back, you can research this yourself. Put nothing but price on your charts. Don't even worry about timings for now. But each day when we roll over, the market will start to auction if we're not already outside of the range. And they'll at some point put a high in place, and at some point put a low in place. And that low may not be in place until maybe London comes in. Or it may be inside of Asia. So we might have a high and a low in place. And then when we get into our next 12 candle window, they're either going to go and work into one side for a reversal, or they're going to break out and expand the range for a reversal, or they're going to break out and pull back and continue to build a bigger box. Monday to Friday. So as Monday starts trading, the week, we get a high of the week and a low of the week. And that might just be in Asia. But for the beginning of that week, we have a high and a low. We know we have money sitting above and below the previous day's highs. And as the day evolves, we have money sitting above the high and low of the day. The next most important thing are the timings. I emphasize this over and over and over again. Last night was textbook. They put a high in place at the beginning of the Europe-London window. And as I said, that middle hour, the equities hour, when that hour finished, we had a low of the day in place, and they proceeded to work into that low. One push, two pushes, pulling back, third push going into the US session 12 candle window. In a few of the pairs they shifted away, pulled back again into that breakout, and then continued it in the equities hour for a 50 pip move. Pound New Zealand, pound Aussie, pound yen. They worked it down and stayed reasonably consolidated in that lower part, but they worked it into the low. We had a high of the day in place. As I said, equities hour, most important. So just coming back to this simple concept, whether it's Monday, Tuesday, whether it's Asia, London, as the day evolves, we're going to get a high. And they might continue to keep building the high. So this may, the low of the day may be the low. They may come down in London and come back. Now we have a new low of the day. So again, I mentioned to a trader asked me, why do I call this the new low of the day? Because that is the low of the day. And we saw that yesterday when they went down and took out the low, the swing low, I believe it was the pound Oz, we're going to look at that. They didn't go all the way to the low of the day. They went into the most recent swing low prior to the Europe-London 12 candle window. That is the new low of the day. I don't believe in support and resistance. I believe in saying, where is the money? And if you spend 3 hours in a 25 pip box and they're working into one side, when we head into the next 12 candle window, you can sure as much believe that they're going to be going back to the other side to go after the traders who shorted it at the London Open. So most importantly, high and low of the day. Build the box. What makes the high of the box? There'll be usually an engulfment or a pin hammer. There'll be something that at some point where they lock in the high with an engulfment, or they've locked in the low with the engulfment. And once they have both of those in place, now we wait, because they're either going to come up and work into one, or they're going to go through to the previous day's high. And again, the timings of that equity hour. Are they working into yesterday's high or yesterday's low in that equities hour? One push, two push, bull pin hammer at the high yesterday, second candle of the equities hour. That is a golden trap. That's a bull candle. Retail traders don't want to short a bull candle. They want to get the perfect little setup. Second candle, equities hour, high of the day, yesterday's high. They engulf it with the third candle. They move it down lower. You're getting filled down low. That's the first sign when they get you to chase a trade that move may be profitable for 10, 15, 25 pips. Chances are, though, when they're working it into the low, it only takes one candle to come back and have you caught. So very important to understand, you want to get filled at the high or at the low. And we saw those reversals set up with bull pin bars at the low of the day on the pound Oz, and we'll look at that again as well. So important to understand, high and low of the day. You should be able to draw a high and a low with a box high and a box low. If you don't have, you might have one and not the other. That means that as we head into the next 12 candle window, their work isn't done. They're still either conducting a stop hunt back into a move, 25 to 50 pips, or they're expanding the range, getting traders to chase that move further away, lower level shorts, higher level longs, and at some point they lock it in and they're going to shift it back. If it's a trend trade, the stop hunt will be back against the breakout. Timings, again, critical. 12 candle window, that first hour will often give us a new high and low, or we'll expand the range and lock in a high and low in place. So we'll get that, if we're already in motion, then that means we're probably going to get our new high or our new low put in place in that equities hour. But again, we're going to go over some examples of how I filter that out based on the numbers and the pattern of the trend and the previous day's high and low. That can give us a huge amount of information even before we get to that 12 candle window. 50s and zeros, 50 pip boxes. Again, people keep asking. The indicators for the numbers are down below in the box, and so are the iSessions indicators. And again, timings, it's in every video, 8 to 11, 2 to 5, that's PM, AM, and 8 to 11 AM, New York Eastern Standard Time. If you're not sure where you're at, Google it. It's really simple nowadays. If you have MetaTrader or whatever, if you've got internet, you can Google that wherever you're at in the world and match those times to New York. Those times are the times. Just a reminder one more time, this Thursday, Chris and myself from Pepperstone, 7:30 Melbourne time, which is 5:30 Perth Western Australian time. So wherever you're at, you can Google that. I'll put the link again below. That's going to be about 45 minutes to an hour. And again, depending on how the questions go, last time we ran over quite a bit. There was a lot of questions. We'll try to get through as much as we can. Thank you again for all the feedback. Let's look at some charts. Keep it as simple as possible. But if you're getting caught inside of a move, get suspicious. Work from the high, work from the low. If it doesn't seem right, sit back and watch and learn, because there's going to be a trade. There's going to be a trade in London. Maybe it's not the best trade. Maybe it's going to go 30 pips. If it goes 30 pips and it's not going any further, and you're saying, well, Stacey said it was 50 pips, start thinking that that means we might be getting 50 or more in the US session. Because if they're working traders into one side and it's not going anywhere, they're building volume up, which comes back to something we talked about yesterday. If they're moving traders up with higher lows or lower highs, they're building volume up, and they'll take this out in one candle, 2 candles, 3 candles. They'll take out 12, 13 hours, 14 hours, 3 days in 2 hours. They will wipe it all out. Well, we've seen that on Thursdays and Fridays. They'll go back to Monday's opening price in 2 hours in the course of a 1.5 hour window on a Friday afternoon for the reversal. So just be patient. Keep it simple. Work from the high, work from the low. That setup yesterday is something that we see over and over and over again. So stay disciplined, stay focused, keep getting better, focus on constant progress, and may the markets go with you.
So this is a 10K filings for Goldman Sachs. You can look this up. It's public information. This is purely from the currency markets. This is for 2013. I've got the last few years. You can go and look up the 2019, 2018 daily trading revenues, number of days, and how much was lost or made. So you can see here they had one day where they lost somewhere between 75 and 100 million, and one day between 50 and 75, 2 days of 25 to 50 million, and 23 days somewhere in between $0 and $25 million. But on the profitable side, they had 42 days of at least $0 to $25 million in profit, 65 days of $25 to $50 million in profit, 50 days of 50 to 75 million, 34 days of at least 75 to 100 million, and 34 days in excess of $100 million. So 225 winning days, 27 losing days. And again, you can look at 2014, very similar, 28 losing days, 224 winning days, 28 days in excess of $100 million. 2015, 38 losing days, 212 winning days, and again, 34 days of in excess of $100 million profit. So coming back to what we keep talking about, it's all about the money. Do not kid yourself. It is a zero-sum game. Somebody has to lose, somebody has to win, and the game is fully stacked in their favor. So just to rehash, who makes up the forex markets? Banks, hedge funds, central banks, corporations, and traders. And again, top 10 currency traders by size and volume: Citibank, JP Morgan, UBS, Deutsche Bank, Bank of America, Barclays, Goldman Sachs, HSBC, XTX Markets, and Morgan Stanley. Now, this is a couple years old, but it hasn't changed a whole lot. If you go and dig, there are obviously a lot more retail volume going through. But point being, the market is us against them. So I suppose what I'm trying to reinforce here is that to think that some technical indicators are going to make you a fortune, maybe sporadically if you time everything exactly right on the right days at the right time, but they have everything configured into these algorithms. They're very smart. They know how to move the markets and trap people to make money. So for those of you who feel I'm being cynical, that's good, because the chances of most retail traders making a lot of money in this market are slim to none. And I'm just painting that picture to demonstrate the amount of work that it requires, and to be patient and not go there trying to trade this market if you don't have an edge and you don't know how to execute it in live time, if you're not fully confident, because you'll lose your money. Trade as small as possible if you're using real money until you get that consistency, and keep it as simple as possible. So today we're talking about boxes, drawing boxes, and yesterday I think was a textbook perfect example on a few pairs. And you know, before we even come to the screen, we've got yesterday's high, but we can draw a high of the day. So again, we've got a high put in place. So engulfment in Asia, and we have an engulfment at the low of the 3-hour Asian 12-candle window. So we have a low of the day. And yes, we have higher lows. We have higher lows, and for all intensive purposes, we will draw those in because they were higher. most importantly, we have a high and we have a low. Now we're in a box, so we have our box in place. And this is important because when we get into the next 12 candle window, we either want to have a breakout, pullback, continuation, or we want to know, are they jamming us into one side? I talked about the first hour will often be the trap and the stop hunt. So they hit stops on traders in Asia. They go into consolidation. We get a bear pin hammer, and then we get the bull pin hammer. So this is a 2-bar combination, but this bull pin, this is where retail traders come unstuck, because the way to get into this trade is you trade the break of the bottom of this candle. It's a bull pin, and you're selling the short. As soon as they break that, and it's all related to timings. It all has to do with timings. So, and again, we'll look at this on the 1-minute chart. I'm going to show something today. And again, I don't encourage the use of the 1 minute. We're going to go back and look at this, but I'm going to just demonstrate something that happened. They put a high of the day in place in the first hour. Okay, and so what I mean by that is they pulled back and they put a swing high in place, and then they put a swing low in place. And they didn't go any higher, but they took out the low again. They worked down in 3 pushes off that lower swing high. 1 push, 2 pushes, 3 pushes. And again, timings now, we're not even at the London hour yet. But as we head up towards the high, the market pulls off again. And we've broken yesterday's high. They come back in 3 pushes, 1 push, 2 push, 3 pushes. And as we head into, this is the first candle of the London hour. So the first candle of the equities hour goes up in 1 push, 2 pushes, 3 pushes to the high before they hit the high and reverse. Now, they take out the low in 1 push, 2 push, 3 pushes down. So timings-wise, okay, we have the opening 15-minute candle has now we've taken out the high, they've taken out the low. They put 3 pushes down and they come back in that third candle, and we get an engulfment and a pin hammer with a middle structure inside of the high that was created at the London Open. And you'll notice it's at the high of yesterday. So I'm only painting this picture to demonstrate that obviously coming back, we're going to show something else here. They went down first prior to the 12 candle window, and they put a low of the day in place. A new low of the day. Okay? A new low of the day. Why? Because it's a higher low. So they put a low in place before they headed into the 12 candle window. So we have our low. We know there's money down here. And then they go up in 1 push, 2 push, 3 pushes, take out the low of the day, put a middle structure in place, pull it back in our third candle, engulf it, pin hammer inside the peak formation for the move back through the low of the day. So you'll notice that there's a triple top formation here. And again, I'm just demonstrating this. I do not encourage you to use the 1 minute charts. You can study them. If you're proficient at it, fantastic. But you don't need to. Again, the timings of that trade were very similar if you shorted the 15-minute second candle of the equities hour. If you were shorting this, again, that flies in the face of what most retail traders are prepared to do. They're not used to shorting a bull candle at the high of the day, but it has to do with timings. They come down, and I mentioned yesterday, your high and your low will most likely be in place after the equity hour has finished. Not to say that it will be the overall low or the overall high, but it will put a level in place that they will then work into. They came back a second time doji, a third time pin hammer. We have a middle structure. This is your W. We have our W in place. They take out the high of the day. They come back in a 1, 2, 3, 4 candles, but it's a 1, 2, 3. They engulf it. They go sideways at the high of the day. They go sideways into consolidation, heading into the next 12 candle window. 1, 2, 3, 4 bars. Our first hour is a continuation open drive candle. And then our equities hour prints with a 1, 2, 3, 4. So we're up high. Comes back. We get our engulfment and a bull candle. And that market proceeds to continue for another 50 pip move. The trade came off the low of the day. They came up and hit stops, went into consolidation. They put a little bit of heat on traders who got in later. But point being, they made a low. They created a low of the day, and they came back into it with a pin hammer. There's your W formation, type 2 at the low of the day. So, again, your box. There was the low, there was the high. They went into the high and sold it down. Then they worked into the low and gave you the W for the reversal, and they gave you the continuation trade in the US 12 candle window. And you'll notice this is an extended W as well. I know traders don't like it when I say this, but it is an extended W for the continuation move. So today we're looking at this chart. I'll just move this over a bit. We have a low of the day in place down from the beginning of the session. Currently, that is our low of the day, and they have put a high of the day in place. So depending on how we head into this 12 candle window, they may put a higher low in place and work into it for a continuation back up, or stop hunt back up into the traders that are short to give us a peak formation, possibly for a retest and a middle structure for a measured move down. All we have right now is a high of the day and a low of the day, traders. One other thing I wanted to highlight here and filtering these out is that as the day started and we had our high and low in place, we had our 50 pip box, 50s and zeros. So we're in a 50 pip box. They came down 25 pips. This is a 25 pip stop hunt up and a 25 pip stop hunt down. They went into consolidation before breaking above the 50 level and then continuing that move. And you'll notice this engulfment closed above the 50. They went into consolidation for the continuation move. So just coming back to today's market, we're above 50 currently and below zero. So depending on how we trade into that 12 candle window, 50 may act as support. We've got a breakout now on top of yesterday's high. We'll watch and see what happens. I thought the British pound was a textbook example again. This is just such a fantastic example of trapping volume inside of a consolidated range, inside of a very tight range. The market trades sideways, but you'll also notice it gave a high of the day and a low of the day. They worked into the low. We talked about this yesterday. They came back down a second time and then gave the W formation, broke out of the high of the day, which is just a tight little consolidation inside of the peak formation high. This gap down is the same as a bear candle. That gap is the same as one big bear candle, which confirms our peak formation. They come back to the high of the day. They break out. They hit the high of the day. They pull back. They go up one more time. At the equities hour, we have our pin hammer. A pin hammer at the high of the day. At the equities hour open, we have a middle structure. That is an M pattern, an M formation. M formation at the high of the day. We're in a 50 pip box from 50s to zeros. The market comes down, hits the low of the day. And again, I mentioned that equities hour. So we have our equities hour low in place, but it continues to go further down, which means our low of the day is not in place yet. They're extending the range. They come down. They still haven't put a low in place until we get this big bull candle pullback. We now have a low of the day in place. They come back and work into the low of the day. When you're down at the low of the day, in the gap time, one push, two pushes, three pushes down, you have to be thinking U.S. session trade. You're at the low of the day and you've got three pushes into the low. Engulfment, bullpen hammer in the gap time, 7 o'clock stop hunt. We've talked about this before in the 717 video. You can Google that in the channel. We get a second engulfment. Okay, so we're heading into straightaway mode. One push, two pushes, consolidation, three pushes, pin hammer engulfment for the continuation move after one push, two pushes, three pushes, 50 pips. And again, looking at today's pound New Zealand, we now have a high of the day in place. We're technically inside of the high of day of yesterday. They've come down and put a swing low in place. They've extended that down further, made a new low, came back a second time. We have a W formation that's come off the low of the day currently. For long trades, the first place this market could potentially fail is at the lower swing high, but again, lower highs, trap volume down low. This lower volume is now trapped, so they're either going to break through that or go into consolidation and possibly retest the lows that are in place, which means we're in the lower 50 pip box, or they will break above, pull back, and continue and retest yesterday's high. Gold gave a great opportunity yesterday right at the open. They put a low in place in Asia. They put a high in place. Then they went back into the high, came down in the gap time, went up, took out the high, and then into the 12 candle window, went up a third time, engulfed at the high of the day, worked its way down into the low of the day, second leg structure, entry on the pin and the 7 o'clock stop hunt. I entered in right in at the numbers. This was a trade that I did take, and I also traded the New Zealand, which we'll just look at that again. This market, when it came down, I was looking at it on a shorter time frame because of the timings. And again, we can look at this. We'll zoom in. Just pardon the delay here. We'll have a look, and you'll be able to see the second engulfment. Very clean to see. They came down and took out the low, the engulfment, took out all three candles. I was filled just at 02 above the round numbers, and the market proceeded to break above that lower structure, which again is trap volume. When the market pulled back up, I was at break even, and that market continued up for a 50 pip move. And again, just looking at the gold today, we can see we've worked our way down. We have a high of the day in place. They have just put a low of the day in place. So we will watch the 12 candle window to watch and see, do they work back down into the low for a move back up, or do they come back up to retest traders that are short in Asia, which means we're still inside. So I'm going to look for the market to either come back down to the low of the day or potentially work its way back up with a breakout pullback in a trend trade heading up towards this morning's high. So looking at the pound New Zealand, similar to the pound Aussie, the other day I took the pound Aussie and the pound New Zealand moved better. Last night I took the pound New Zealand and the pound Aussie moved better. I was out and got home after the equities hour, was just about to finish trading, and the market I saw had already broken through, but when it pulled back and gave us the little engulfment, when it broke up just above the 25 level, I was in long in that market with a 1-bar stop. My stop is this swing engulfment right here. That market proceeded to move very strongly, and this is what you should expect. When you're entering into a trade like this, it should be moving quickly. If it doesn't move quickly, I get very suspicious, and I'm prepared to cut the trade or tighten my stop, or very, very tentative, because it needs to break hard and fast, because we're already in a breakout mode. And this is technically, if we zoom in here, we're looking at a market that is now in a stop hunt mode. So it's going aggressively back to an area to stop out traders who potentially are still in profit or are holding on to positions or move stops or whatever, but also to bend the arm of traders that have hung on to something down here hoping that it would come back and blow out their trading account. Remember, it's about the money. So looking at today, we have a low of the day in place from the rollover. Again, that gap down is the same as a big bear candle. They've come down, initially went up in Asia, gave us a high of the day. So again, the equities hour, 1, 2, 3, back up inside of that peak formation before rolling over. We have our high of the day, and we have our middle structure for our M pattern. Timings. Now we're breaking to new lows, so they're working the low of the day. They're not quite in breakout mode, but we're at the low of the day. We're at the quarter level. We potentially could see this market still work its way down to double zeros and get traders that were long. And you'll notice that trade, if I was still in that, I'd be stopped out at break even, but there'd be traders who have stops just below the swing low on the engulfment. So it wouldn't be surprised if we see this market continue to move lower, but possibly you could see it come back first before it breaks down to that lower level. So hopefully you got some value from today's video, traders. Again, high and low of the day, the timings. If you're not at the high or the low, be patient. There's going to be something. If you miss something, learn from it. The next session will be an opportunity. If you miss the high of the day, look to get the low of the day. If you're missing the low of the day, possibly they're going to come back to that, or they're going to make a new high of the day, and you'll be able to look at trading the market from there. If it's a trend trade, as you saw last night, the momentum will be there. The market's going to be breaking out and pulling back and continuing the move with momentum. Engulfments, pin hammers. Have a great trading session. Keep it simple. Keep getting better. And may the markets go with you.
Hi, traders. It's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, The 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.